Our next guest does still think we're in a bull market, but he's concerned that emerging markets aren't growing fast enough to make up for the slowdown that we're experiencing in the developed world. Michael Jones is the chairman and CIO of Riverfront Investment Group, and he joins me now this morning from Seattle. Good morning to you. It sounds like you're hitting on something that Bill Gross has touched on here, which is that the developing world isn't consuming fast enough to make up for this gap in spending here.
Absolutely. If you think about it, the last 20 years in the global economy have been led by the U.S. consumer spending a lot and going deeper in debt to finance it. That game is clearly over, and the question is what is coming online to replace the U.S. consumer in the global economy? There's clearly plenty of capacity in the Chinese consumer to more than replace that source of demand. You've seen almost a day doesn't go by without double-digit wage gains being announced in some component of the Chinese economy. But so far, a great deal of those wage gains have been going into higher savings rather than accelerating consumption. So the question before the market is as stimulus spending in the U.S. fades, as Europe gets newfound religion on cutting deficits, those slowing parts of the economy, can they be compensated for by a faster acceleration out of China?
And yet this morning what we heard from the IMF is that they're feeling a little bit better about global growth, and in fact, sort of gave good grades to the United States and to Canada for leading the developed world here. I mean, explain what it is that you're most concerned about here, because today's retail sales numbers are showing that the consumer may be jobless, but they're still finding some way to spend.
Well, we think that the real challenge is, can those trends continue once we have exhausted the inventory rebuilding cycle, once Europe is really deep within their austerity packages, and once stimulus spending finally fades out of the U.S. economy, most especially some of the unemployment benefits. They're having a hard time extending those unemployment benefits in Congress right now, and that's obviously a huge component of retail sales right now. So as all those things that are fairly easy to forecast come online, where does the new growth come from? We believe there's more than enough potential in China. The question is will they catalyze that potential growth by allowing yuan to rise faster than they've thus far been willing to do?
Right, but that's always the question with China. Does potential actually equal activity right now? But I thought that the decoupling theory kind of died along with Lehman Brothers, but you are finding opportunities in emerging market small cap stocks. You're still betting that there will be consumption in the developing world.
And there's definitely, the consumption growth has been dramatic. I think in the IMF report you just announced, they're accelerating Brazil's expected growth to more than 7%. So you're definitely seeing consumption growth that's very powerful and very dramatic. And in the small cap component of emerging markets, you're tapping into that consumption spending. But the consumption spending, the big kahuna in consumption spending, is getting consumption from 40% of the Chinese economy to 60%. That's the kind of thing that really lifts the global economy, not just the emerging markets.
Right.
And thus far, that's the thing that we haven't seen yet.
Today, S&P 500 is up. We're at 1065 here. I know you were very much focused on S&P 1000 as the bottom there in this pullback. How have you reset your technical levels?
Well, right now, we like what happened yesterday. We got down close to 1010, and the market really defended that what we hope to be the bottom end of the range. We've got three tests for are we out of the woods yet in terms of this correction. We want to see credit default swap spread stay below 700. That's a check. We want to see the 200-day moving average continuing to rise. That's a check, but it's really close. And finally, we want to see the 10-year back above about 340. We're a long way from there.
All right. We'll watch those. Thanks, Mike, for joining us today.